Monetary Policy Committee is set to meet for the first time in the current fiscal year on Friday. Now, not much has really changed in a sense from when it's last met. Economic growth continues to remain strong and resilient, while inflation, though still above target, is showing encouraging signs of easing going ahead. We're in conversation with Arvind Chari, the Chief Investment Officer at Q India, for a special chat ahead of monetary policy to get a sense of what his expectations are from policy on Friday. Thank you so very much, Arvind, for taking time out for us.
Thank you for having me, Pallavi.
So, the expectation broadly is of a status quo from Friday's meet. But do you think you would not rule out a change in stance just as yet?
So when you talk about the monetary policy stance, right, the RBI current has been having this stance of withdrawal of accommodation. And I think I made a comment back in October that, they have to start thinking about changing that stance because they had hiked already to about 6.5, and then they had some more hikes to go. And given where inflation was trending and where inflation was settling, at least for the last two policies, that has been a discussion, especially in the markets and with the RBI, and there have been regular questions asked RBI saying that why do you have that stance? In fact, even Jayant Verma, who is the monetary policy member, has been voting against that stance of having withdrawal of accommodation. I think there is a case for them to move to neutral. Now, I can get a sense of why RBI is kind of have not changed the stance, because I think they are taking the cue from what the Fed did. So when the Fed first indicated that they have reached their peak rate and then they will soften their stance, the market took it as a rate cut, a very near rate cut, and you saw a big rally in the US 10-year, right? I think the RBI wants to avoid that situation where they don't want the markets to front run what they intend to do with the monetary policy. Broadly, if you see, most central banks have kind of stopped giving very explicit forward guidance. Now the Fed has a dot plot, the RBI has this stance. But broadly, most central banks have because the conditions have been so data dependent or volatile in terms of commodity prices and demand and supply conditions and supply disruptions. So that's why I think they've been wary. I still feel I think the RBI has done enough in terms of rates and has got inflation well and below under control. Thanks largely also to the government, and there is clearly a case for them to move to neutral, where basically they should indicate that we don't intend to hike, but it is not a cut. But we are in a neutral monetary policy where if the conditions of our inflation expectations are met, then the next possible move could be a move down. But you can always guide the market in terms of how they should expect that. But having a withdrawal of accommodation where they are not actively sucking out liquidity, nor are they hiking interest rates, it does not make, I don't know what sense they are trying to convey by still talking about withdrawal of accommodation. Maybe in this policy, if they term it properly and they have the confidence, maybe they'll move to what we call neutral stance, where they're neutral in terms of where they are with the monetary policy both. And in India, monetary policy is rates and liquidity, right? In some sense, from a activity and transmission perspective.
Right. Also, a while back, the conversations now shifted to when the RBI will come around to cutting rates. Yeah. Pretty much, that's pretty much the case across central banks, yes. Right? But in case of India, even when the RBI does cut rates, be it middle of this year or maybe a little bit after that, India's rate cut cycle is still expected to be a shallow one, right?
Right, yeah. Yeah, if you look at long-term rate cycle average, right? If I look at a 20-year average of the Indian repo rate, it's been between 6 and 6.5%. Right? If you look at long-term average CPI inflation, it will be around between 5 and 5.5%. So as compared to developed markets, developed world, where the current rates from a 15-year historical perspective is higher than what it was, And that's where the impact on the economy and the impact on the markets and the impact on conditions are different. Whereas in India, we are at 6.5% repo and 7% bond yields. We are at about the long-term averages. So Indian households, Indian businesses, Indian government, and the policymakers know how to operate in this segment, right? Given the fact that now we are in an inflation targeting environment, right? Barring shocks on either high side or on low side. So high could be very high oil prices, or low could be things like COVID, where the central banks and the government has to intervene in a major manner. Barring that, if you take that 4% plus whatever 1 to 2% real rate, you should expect that the general normal average repo rate will be between 5.5% and 6.5%, right? Given that you need that buffer of real rates. So that's why even if the RBI cuts rates, it will be 50 to 75 basis points. If everything else remaining constant, right? So if the growth trajectory falls a lot more, then they will need to do a bit more to support growth. If there is another commodity shock in terms of rising commodity prices or rising oil prices, then maybe they will react to the otherwise. But otherwise, it is a shallow cycle. But they need to think about in terms of what is the exact rate, what is the relevant rate they require for the growth that the country desires to achieve.
Right. I do want to ask you about where we're headed in terms of bond yields, both in terms of domestic as well as global cues.
Yeah.
What's the range you're looking at for the benchmark yield?
So if you look at build-up of how we look at inflation risk premium and term premium, right? Those are the two things that matter to long-term bonds, which is a 10-year is a long-term bond yield. So given the fact that the RBI itself is guiding that CPI will head towards below 5, towards 4.5, and the current numbers suggest that actually it will surprise on the downside, like the actual headline core, or what I look at CPI ex vegetable, it's all going towards 4 or below 4. From that perspective, if you then take some inflation risk premium, which is basically real rates that the central bank itself wants to have and then it wants to give to the market, so about 1 to 1.5%, right? And then you build in term premium in terms of where you want to have liquidity and term premium. So from that perspective, if you build up that from that perspective, you should expect some amount of reduction in bond yields, maybe closer towards 6.5%. I'm not saying that's fair valuation, but you can see just from a build-up of inflation risk premium and term premium currently. And then the other thing that matters is, of course, demand supply, right? And today we see demand supply is very favorable. If you look at the demand from domestic banks, given the growth in NDTL that they have seen, given the LCR requirements that they need to have, I think we are already closer to the threshold of demand from banks for SLR. You should expect the same from insurance and pension funds. We don't see too much long-term issuances of corporate bonds yet. So their demand for long liabilities, long asset will come from buying longer dated government bonds. And then, of course, there is the foreign FPI demand. Right? We've already seen about $9-10 billion of flows since the time that the bond index inclusion is announced. And given whatever estimates go around in from the street, it's about 15 to 25 billion dollars of eventual flows should come in. A mix of both passive bond flows, just tracking the index, and active managers who use the JP Morgan Emerging Market Bond Index as their benchmark. And if India is 10% weight of that, they will want to have some, some could be underweight at 7-8%, some could be overweight at 10-11%, but no one can ignore or not have India bonds in their portfolio. So they'll have to be, if you add that up, given the domestic demand supply and the foreign, I think from a demand supply perspective also, it's favorable for bonds. So when we've seen scenarios where when the demand supply is favorable, the 10-year bond yield actually trades a lot closer to the repo rate. So even if the repo rate remains at 6.5%, we've seen 10-year bond yields at 25 to 40 basis points of trading above that, right? So that's one way to think about it. Even if the repo rate gets cut, you would expect favorable demand supply, and the fact that the inflation is very much under control and you do not need as much term premium and liquidity is comfortable, you should expect bond yields to go down. And you're seeing that in positioning. right? Both from foreign investor and the domestic, you're seeing an increase in duration profile in funds. Like if you look at bond funds, their average duration profile has gone up. If you look at what foreign investors also are buying, given the fact that they buy that fully accessible route, securities which are in that FAR security group, you're seeing they are preferring to buy more, like slightly more duration as compared to buying at the very shorter end, which is indicative of the fact that everybody is expecting some some easing in yields. Now, there are two risks, and one risk in India is always oil prices, right? If there's one short-term risk that India has, that's oil prices. So if oil prices bump up, and you could see some amount of increase in oil price in the last month. If it goes well above $90, $95, $100, then you will see some impact on rate expectations, inflation, and hence on bond yields. And the other is, given the flux in the global markets on where central bankers are headed and where global bond yields will go, if the US Treasury yields are a reasonably dominant factor on how markets and global markets think about emerging market bonds as well, right? So those two factors are kind of the risk or the swing factors. But otherwise, from a domestic perspective, inflation, term premia, demand supply is very, very favorable for bonds. Yeah.
I think it's fairly well sort of etched out what's working in favor of India. In a recent LinkedIn post of yours, you did highlight some concerns as well. And these are concerns that we know about, right? Private consumption, for instance. And exports, of course, is picking up. But in case of private consumptions, the trajectory going forward remains a little unclear. And there is a fair chance that the gap we're seeing between investments and private consumption continues at least for maybe the next year or so. It remains to be seen how that is playing out. So what are you making of that?
So if you look at the overall consumption is linked to incomes, right? So if you look at the income profile and the consumption profile, since demonetization, we've seen a reduction in incomes of certain segments of the economy, right? And they had multiple shocks at demonetization. Then GST was a good reform, but it had an impact on unorganized segments. Credit crisis was specifically to finance, but it did choke up funds into SME and unorganized segments of the economy, and then COVID. Right? So of course the government provided some support on food and some income support, but still broadly, if you look at the income growth in the economy has been lower than its historical average, and has been lower even now. So you can see that in FMCG sales. Now people will debate whether it is because of choice and because of competition, but you can still see a general sentiment and a I won't say weakening, but the consumption trajectory is still not back to where it would have been at the current level of growth. Now, for a growing economy that we are, of course, we need more investments than consumption as a share of GDP, right? Because investments is what eventually will drive long-term sustainable growth. But there is need to have a balance between how much consumption and investment. So supply side and demand side. This is where now if you look at from a monetary policy perspective as well, if we are okay with India growing at 6 to 6.5 real GDP, right? That has been our long-term 20-year, 30-year average. And if you are comfortable growing at that level, maybe the current level of interest rates, the current level of real rates are okay. But if we believe that the consumption should be growing or income should be growing at a slightly faster pace, and that requires support, so that the amount of supply side capex or investments that the government has done will ensure that India can actually grow at, say, 7% in the medium term, and that requires support. Maybe that's when the RBI has to think about whether right now, if you look at real rates, if you assume 4 to 4.5% as sustainable inflation, and if you look at 1-year T-bills or 1-year State Bank of India FD at about 7%, that's about 250, 300 basis points of positive real rates. Now, is that required when the GDP growth is still in that 6.5%, or does that require some reduction in both increase in liquidity and rates to be able to take the GDP growth, slightly, or support the consumption income? That's one aspect to think about, because broadly, India still grows at that long-term GDP still remains about 6 to 6.5%, right? But increasingly we are seeing many like even from the government or even the RBI mentioned that these sustainable potential growth could be 7% in India. And if you take that into consideration, do you require 3 percentage points of real positive rates at this stage of the economy? So that was one thing that I guided on, that although the GDP growth print is at 8%, but the actual consumption and income growth is still lagging that indicator. Maybe the trickle down takes time and you will see more consumption income growth. But right now, it is better to be realistic about what is the long-term growth projection and potential. So it was more from a guidance to investors saying that India always disappoints both the optimists and the pessimists, and it pays to be realistic about the expectations. And I just cherry pick 4 or 5 indicators to show that although the narrative is very positive, and that's what we continuously hear from foreign investors also, that the narrative in India is good and everybody is looking to have an allocation to India, which is good to see. But you have to always temper your expectation in terms of what returns can you earn in India and what are the actual realities. So that was the post that I posted.
Right. From a global perspective, we've seen fairly encouraging data come on multiple fronts, right? China is looking relatively a little better, as is the US. So globally, what's it looking like?
So if you look at the US economic data, as I said, I've written about this before. I think markets made a big deal about interest rates from from like small changes in interest rates impacting the economy. As you're seeing now, even at a 4%, 5% Fed funds rate or treasury yields, the economy seems to be doing well. So of course, there is a problem for the borrower. If you've borrowed a mortgage at 2%, and the mortgage resets to 5-6%, of course there is a cash flow impact, right? You see less of that in the US because they have fixed rate mortgages, but you see more impact in countries like Australia or Canada or UK, where where the mortgage rates are floating. And so when the reset happens, there is an impact on EMIs and your monthly payments and your incomes. But broadly, from a corporate activity perspective, given the fact that during COVID, there was so much fiscal impulse, initially to support people's incomes and then to support businesses, right? There was, all countries did a mix of these two aspects, supporting incomes and then supporting businesses. So you are still seeing the lag of that. Maybe some countries have tightened their fiscal, they've reduced the support, they've removed some amount of subsidies, but there is still enough investment-driven activity or investment-driven stimulus that is available in the global world, and that's why you're seeing not like the high interest rates have not caused a major recession, which is what was worried, which is what the worry was,
expected.
Right? So you're seeing economies and corporates actually kind of relatively managing the situation better. In India, surprisingly, we are not seeing that in, say, non-oil goods export, right? We saw a bump in...
That appears to be indicating a little bit of an improvement as well.
We saw an increase in 2020-21, but last year has been more or less flat, right? So if the global economy is indeed doing well and supply chains are back and the disruptions are not there, then you should have seen a bit more increase in non-oil goods exports. We saw that in service exports. Service exports have done very well and continue to do well, but non-oil goods has remained a problem in India, and it has grown, hasn't grown at the pace, but the global economy is giving you opportunity. That tells you maybe impacts of import duties that we have seen, or maybe India is still not in the global supply chain of manufacturing, right? It'll take some time. But otherwise, as of now, the data is showing that high interest rates has not created a recession in the global world. I think both households and corporates have been able to manage the impact of high interest rates in a reasonably okay manner. We'll have to see how that pans out in the next 1 year.
Right.
As of now.
With that, we're completely out of time, but thank you so much for taking time out for us today.
Thank you so much.
Stay tuned to NDTV Profit for our continuing coverage on the Monetary Policy Committee's meet, which is scheduled for Friday.